It was financial advisor Robert Hopkins who said they take the money out of your paycheck before you can go out and spend it. In this lesson, we're going to interpret and use the information on a pay stub, W-2 form, and a 1099 form. All to answer the question, why is your take-home pay lower than your salary? Before we begin, let's make sure we're ready for this lesson by taking a look at warm-up number 2. Write an expression that models this situation. Rich wants to buy a coat pricing at X dollars. It is on sale for 20% off. He must also pay 7.25% sales tax. Write an expression for the final price of the coat. This means that the price of the coat, being X dollars, will be subtracting 20% or 0.2 times X. We're also going to be adding in the sales tax of 7.5%, so 0.725 times the value of X minus that 20% or 0.2X. This will give us 0.80X. With that, we go ahead and add the sales tax of 0.725 times 0.80x. And this is going to be equal to 0.8x plus 0.58x, which will give us 0.858x as our answer. Now, let's take a look at a problem that you will be able to do by the end of this lesson. Amy Springfield works for Pound Ridge Financial Planners. Her employer uses an electronic W-2 form as shown. What accounts for the difference between her wages listed in box 1 and her Social Security and Medicare wages listed in box 3 and 5? There's a $13,200 difference between the amount in box 1 of $87,900 and the amount listed in box 3 and 5 of $92,100. Both are earned wages, but they reflect different income amounts used for the calculation of Amy's taxes. The 6.2% Social Security tax and the 1.45% Medicare tax were calculated on $92,100, her total income. Amy made tax-deferred contributions to her retirement plan. The $12,200 shown in box 12A was deducted from her gross earnings before the federal and state taxes were calculated. The money is being placed in a qualified retirement account. Therefore, the taxes on the money are deferred until Amy makes a withdrawal from the account after she retires. The tax-deferred contribution to Amy's retirement funds only account for part of this difference. There is still $1,000 that must be identified. Box 14 lists CAF 125 $1,000. Section 125 of the U.S. Tax Code outlines a cafeteria plan in which employees can hold back a portion of their pre-tax wages for the payment of certain medical, child care, and parental care and reimbursement of medical insurance expenses. The cafeteria plan is a type of flexible spending account, or FSA. This is an employer-sponsored plan in which employees choose to deposit funds that will be used for the sole purposes outlined above and only in specified 12-month periods of time. This is a use-it-or-lose-it plan. If all of the money in the plan is not spent by the end of the 12-month period, the money cannot be returned to the employee. Box 14 indicates that Amy deposited $1,000 into the account. The sum of the tax-deferred contributions and the FSA deposits accounts for the difference in total wages. Employees have many expenses. These include federal income taxes, state income taxes, city income tax, Social Security tax, Medicare tax, disability insurance fees, pension plan contributions, dental insurance fees, and medical insurance fees. These expenses can add up to thousands of dollars each year. Rather than having employees pay these costs in a single yearly payment, they are distributed throughout the year. Amounts are withdrawn or subtracted from the employee's gross pay or total pay. The amount of money that an employee takes home is their net pay or take-home pay. With each paycheck on a pay stub or pay slip, employees receive a summary of their wages and the amounts that were withheld. The amount for tax withholdings are based on the information that employees submit on a W-4 form, the Employee's Withholding Allowance Certificate. The employer withholds the taxes and sends the amount to the appropriate government or private agency. Federal, state, and local income taxes are withholding taxes since employers withhold these taxes and send them to the government. Social Security and Medicare payments are also withheld and sent to the government. An employer keeps track of each employee's withholdings and deductions. All data is reported to you on a Form W-2, wage and tax statement, which must be given to employees by the end of January. This information is used to compute federal, state, and local income taxes. When filing your income tax form, you must submit a copy of your W-2. Not all income comes from wages, salaries, and tips. People make money from interest on banking accounts, interest on stocks, royalties, and more. These types of incomes are not wages. It is up to the taxpayer to report this income on their yearly tax forms and pay taxes directly to the government. Rather than getting a W-2 form for these sources, taxpayers are sent a Form 1099. These amounts are reported to the government as well as to the taxpayer. Here, we're going to learn how to make calculations based on reading a pay stub and a W-2 and 1099 form. Barbara started a new job and wants to verify that her net pay has been computed correctly. Her gross pay per pay period is $469.75. She has the following deductions: Social Security tax at 6.2%, Medicare tax at 1.45%, federal withholding tax of $110.51, state withholding tax $66.62, and a retirement insurance contribution of $9, disability insurance fee of $2.56, Medicare insurance fee of $12, and a dental insurance fee of $6. What should her net pay be for this pay period? First, let's calculate the Social Security and Medicare taxes to the nearest cent by multiplying the gross income by those tax rates. So, $469.75 times 0.062 for Social Security is going to give us $29.12 as it rounds to the nearest penny. If we multiply that $469.75 by 0.0145 to find the Medicare tax, we're going to find that we get $6.81 rounded to the penny. Now we're going to add up all of the deductions of $29.12, 6.81, 110.51, 66.62, 9, 2.56, 12, and 6 for a total of $242.62. So if her pay is $469.75 and we subtract the $242.65, we wind up with $227.13 for her net pay. Let's check our understanding of this. What percentage of Barbara's gross pay for this pay period accounts for all of her deductions? And we're going to round this to the nearest 0.1%. To do this, what we're going to do is we're going to find her total salary of $469.75 minus how much is her deductions, $227.13, and divide that by her pay of $469.75. This is going to give us approximately 0.516, which means 51.6%. Now let's interpret and use the information in a pay stub. Examine Lorna's biweekly pay stub. Assuming that Lorna's salary and deductions remain the same throughout the calendar year, how much will be taken out of her total annual gross salary for federal and state taxes? Lorna receives 26 paychecks a year. The federal and state withholdings are consistent. So her federal times 26 will give her her federal withholdings tax, meaning $1,001.47 times 26 will give us $26,038.22. Now her state deduction times 26 will give her state withholdings. That would mean $280.89 times 26 will give us $7,303.14. By adding these two together, we're going to wind up with $33,341.36. So her total deductions for state and federal taxes for the year are $33,341.36. Let's check our understanding here. Employees can choose to increase their tax withholdings if they feel the amount calculated for the tax deductions may not be enough to meet their total tax responsibility at the end of the year. From her past records, Lorna knows that her total tax responsibility is usually 30% of her annual salary. At the rate of deduction shown on the pay stub, will Lorna's employer have taken out enough of each paycheck to meet her tax obligation for the year? Explain your answer. Yes, approximately 35% of her annual salary will be deducted for taxes. Your personal W-2 form is a yearly accounting of your tax withholding for a given employer. It includes personal information about you as an employee, such as your name, address, and place of employment, Social Security number, taxable earnings, taxes paid, and more. If you work more than one job during a tax year, you will receive a W-2 from each employer. Now, let's interpret the information on a W-2 form. On January 30th, Joanne Toscano received this W-2 from her employer. How much did Joanne pay in federal, state, and local taxes during the year? On this W-2 form, the federal tax income withheld listing is in box 2. The state tax is listed in box 17, and the local income tax is listed in box 19. The total amount that Joanne paid this year in taxes is the sum of these amounts. So $15,851, $5,344.50, and $1,092. Adding those up, we get $22,287.50. So Joanne's total amount paid in taxes for the year is $22,287.50. Now, let's check our understanding of this. What percentage of Joanne's gross income did she actually take home? We know that she earned $76,350, but how much did she pay in total? Well, to state income tax, she paid $5,344.50. She also paid $15,851 to federal tax, and she paid $4,733.70 to Social Security, along with $1,107.08 to Medicare. Let's not forget that she also had to pay in $1,092 to her local income tax. This means she paid a total taxes in of $28,128.28. When we subtract that from the $76,350 that she's earned, we get that she has a take-home of $48,221.72. So if she got to take home $48,221.72 out of her $76,350, this is going to give us 0.631, or approximately 63% she gets to keep. Amy Springfield works for Pound Ridge Financial Planners. Her employer uses an electronic W-2 form as shown. What accounts for the difference between her wages listed in box 1 and her Social Security and Medicare wages listed in box 3 and 5? There's a $13,200 difference between the amount in box 1 of $87,900 and the amount listed in box 3 and 5 of $92,100. Both are earned wages, but they reflect different income amounts used for the calculation of Amy's taxes. The 6.2% Social Security tax and the 1.45% Medicare tax were calculated on $92,100, her total income. Amy made tax-deferred contributions to her retirement plan. The $12,200 shown in box 12A was deducted from her gross earnings before the federal and state taxes were calculated. The money is being placed in a qualified retirement account. Therefore, the taxes on the money are deferred until Amy makes a withdrawal from the account after she retires. The tax-deferred contribution to Amy's retirement funds only account for part of this difference. There is still $1,000 that must be identified. Box 14 lists CAF 125 $1,000. Section 125 of the U.S. Tax Code outlines a cafeteria plan in which employees can hold back a portion of their pre-tax wages for the payment of certain medical, child care, and parental care and reimbursement of medical insurance expenses. The cafeteria plan is a type of flexible spending account, or FSA. This is an employer-sponsored plan in which employees choose to deposit funds that will be used for the sole purposes outlined above and only in specified 12-month periods of time. This is a use it or lose it plan. If all of the money in the plan is not spent by the end of the 12-month period, the money cannot be returned to the employee. Box 14 indicates that Amy deposited $1,000 into the account. The sum of the tax-deferred contributions and the FSA deposits accounts for the difference in total wages. Now let's check our understanding of this. Amy pays 20% federal tax and 7% state tax. How much did she save in taxes by putting money into her tax-deferred and flexible spending account? The first thing we're going to consider is that there is a total of $13,200 of tax-deferred money here. Had she paid the 20% that would have gone to the federal tax, that would have amounted to $2,640. Had she paid the 7% state tax, that would have been $924. By adding those together, we see that she saved $3,564 by having those tax-deferred options in her pay stub. Another type of income statement is the Internal Revenue Service Form 1099. This form is used to report different types of income other than wages, salaries, and tips. This can include bank interest, royalties, contract work, unemployment benefits, and so on. Different 1099 forms are used depending on the type of income. An example 1099 form is shown here on the screen for a taxpayer who makes royalties from the sale of a book that he wrote. Unlike the wages reported on a W-2, a 1099 has yet to be taxed. It will be added to the employee's total income and used in the calculation of taxes when filling out the income tax return. Avdi must report this royalty amount as income when filling out his income tax form. All IRS forms and instruction booklets can be accessed on the Internal Revenue website of www.irs.gov.